Well, as we look ahead towards the US CPI print and the formal start to Q3 US earnings season, we are seeing the momentum build in US equity markets. We've got an all-time high coming through in the S&P futures and S&P cash. We've got a closing high in the Dow, and the Nasdaq futures sit at the highest level since July of this year. Now, of course, the Fed put underpins that momentum we've been seeing, but we've also got a very solid US economy, and obviously the word resilience comes through, and that economic resilience is more than trumping the reduced rate cut expectations that the market's been putting in. Now, talking of Trump, we are seeing a slight lead build in both the polls and also the betting markets, and that has big implications for markets, certainly around the tariff side. And we focus on all of those factors in today's trade-off. So stay tuned. Let's get in front of the charts. Well, hi, I'm Chris from Pepperstone. I'm going to be joined in 2 seconds by Blake Morrow from Forex Analytics, and we will be discussing the various macro thematics, bottom-up situations that are playing through earnings. We're talking politics, we're talking setups, we're talking the flows that need to be on your radar. They're certainly very much on ours. So, Mr. Blake Morrow, would you come please into the programme? Now, we're going to be talking a little bit about politics today, because I think it is now time to put it onto your radar. Of course, a lot of the US election trades are still getting caught up with China macro, with what's happening in US rates repricing, what's happening on the economic front. And so pulling outright trades is still very, very tough to do, but we are seeing signs of that playing through. So it pains me to say, and I'm sorry for everyone at home, but I think it's now time for us to start talking about the election. How bad are we?
Oh, it's painful. It's painful, but you said bottoms up, and I was looking for my whiskey tumbler, and I didn't see it here. So,
Fair enough. But yeah, unfortunately, that's the way we are. But there's a lot going on in markets, as there always is. You know, we've got what's going on in China. Obviously, markets trading there like a small cap penny stock, effectively. And obviously, we talk about that. We're talking about rates and the re-emergence of the US dollar. The dollar for me right now is a mythical, magical beast, and I feel like it goes higher in the short term, Blake. But I want to discuss this all with you in Topical Thunder. Let's go straight into it, buddy. Well, I'm going to kick off with the US dollar. The dollar-y-do, because it is finding form at the moment. I don't think it's overloved at the moment, Blake, but when I look around in terms of, let's go on the growth side to start with. We look at growth. We've got the US economy growing around 3%. We've got Germany in a recession. They just downgraded, the government downgraded their growth forecasts today. We've got a French budget which is being put in place, and over time that's going to make them more austere, which is going to lower growth. You've got the highest savings rate in Europe, even higher levels now than when they were during the pandemic at 15%. US savings rate's been drawn down. Obviously, that's a show of what's been going on. You can talk about the interest rate side of things, Blake. We saw the RBNZ cut 50 basis points yesterday. There's talk they go 75 at the next one. The Bank of Canada, on their meeting later this month, expected to cut by 50 basis points. You compare that to Fed pricing that's coming out. You've got economic exceptionalism, rate prices working very much in favour of the dollar. You've got an election which, if tariffs go through, is a dollar positive. It's not, for me, it's hard not to like the US dollar here.
Yeah, it's definitely not the least dirty shirt in the hamper. Matter of fact, it might be the only pressed shirt that you have in your closet at this point in time. So, the dollar is, and don't forget, everybody just came off being very, very bearish, the dollar, just the last couple of weeks. So the dollar recovery makes a lot of sense to me. I just don't think, Chris, it's going to be a straight line. We got the FOMC meeting minutes today. I'm not so sure. All the Fed governors are really on the same page as of yet. So we're going to need that data, and that data this week happens to be inflation. And we're getting CPI and producer prices here in the next 24 to 48 hours here in the United States. And I hate to say it, we are going to be kind of U.S. centric as we go into the end of the week. I know we have UK GDP that might be a little bit of a market mover, but we just came off the RBNZ, as you pointed out, and inflation is going to matter. I know everybody's like, focus on jobs. We just had this huge jobs report, but what if, Chris? What if inflation doesn't come in? It comes in line, or maybe even drops a little bit.
Have you seen the next topic, mate? Have you seen the next topic we're talking about?
Oh, are we already in the next topic? We are in the next topic. We might as well. No, let's. Okay, sorry. I'm going into the next topic. Shoot, I forgot we're not doing the merge into. We're going into. But look, Chris, I think the dollar has a lot to offer right now. But like I said, I don't think it's going to be a straight line. What do you think?
Well, mate, I love. Yeah, I mean, I don't love the dollar. I don't love anything. I'm a bit of a robot cyborg, but. I think the fundamentals and the technicals align right now, and I think the winds to the dollar's back. I mean, let's go past the CPI. I think, obviously, the market now is pricing a 75% chance of a 25 basis point cut in the November FOMC. The big one, of course, get past CPI, get past all the other factors, is going to be the 1st of November. We're going to get the October payrolls. That is going to be big. If that's another big number, if the unemployment rate stays at 4.1%, perhaps even goes a little bit stronger, goes down to 4%. The Fed could be holding off from cutting rates in that November meeting. Going against the dots, and also going against this other wall of central banks which are going into outsized rate cuts. I mean, it just puts the US in such a different situation from the rest of the world. It's going to rely on another strong jobs number, perhaps the CPI number, but we're talking about the dollar. You've got economics working. The trend in economics is improving at a faster rate in the US than other countries. You've got better relative growth. You've got rate differentials working. Potentially you get the election trade working. It all feels to me that the wind is to the US dollar's back at the moment.
I do agree. And technically it looks really good as well, which we're going to get into, obviously, those charts in a little bit. But I want to go back to, and I'm sorry I jumped forward into CPI, but I do want to talk about inflation, because there's this common misconception for some reason that the Fed just cut rates by 50 basis points. We might actually, after this inflation data, we might take a step back and go, oh my God, why'd they do that? After this week, that might be the backtracking, like, oh, is the Fed even going to be cutting for the rest of the year type of, we might be in that situation.
Let me jump in, because the funny thing is that, we went into the last Fed meeting and people were saying they were behind the curve, and now the other argument is being made in some circles as well. So, how it changes, mate.
It changes, and it changes so rapidly. But here's the thing, you got the dollar, and I'm just coming off of today's North American or America trading session, and the dollar was just bid like crazy. We had the dollar yen above 149, which it still is. Euro dollar slumped to continue to slide below 110. The dollar was just bid all the way around. But the markets might have to rethink that going into tomorrow, because the inflation data, it may not come in strong. A lot of people have the, like I said, misconception. Fed cut 50. For some reason, it's going to leak back into the market, and we're going to get this in inflation surge. That could happen, and it could happen in the coming months, but it's not going to happen as of from 3 weeks ago. So, be careful of expectations as we go into CPI tomorrow. I wouldn't be surprised, Chris, if we see CPI come in nominally below, at expectations, or maybe even slightly below. I think the disinflationary animal is still around. So what are your thoughts about inflation as we go into tomorrow?
Well, the market has and the data flow has a tendency to do the opposite of what the market narrative is building on, and that building on now is one where the Fed are reducing markets reducing rate cut expectations, and the dollar's rallying. So one would suspect, taking a more cynical approach, that we're going to get a below consensus CPI number. The market is looking for 0.2% on core month on month and 3.2% year on year rate. So, anything that rounds down to closer towards zero on the month on month clip would be obviously dollar negative and could in some ways be good for risk. It would reinstall the idea that we're going to get a 25 basis point cut. Use that 25 basis point cut for November as your magnet. Effectively, that's the move the Fed want to make. They really don't want to be in a position to cut 50 again. That's going to show that we're going to see a deteriorating labour market and other factors. They don't want to be doing that, and the barrier to cut 50 is very, very high. That said, the barrier to keep rates on hold is fairly high as well. So the Fed want to cut by 25 basis points, I think. But I think there's more chance that we're going to, obviously a much greater chance that we get no rate cut than a 50 basis point cut. So I think, there's probably a bigger reaction in markets if we get an above consensus CPI number than the reaction we get from a below consensus number, given those dynamics. And therefore, I think we get something like above 0.35 of 1% on core. You get a fairly punchy US dollar rally, because you're going to see those rate cut expectations come down to about 50% for November, and I think you'd see a bigger rally in the dollar on a beat or an upside move on CPI relative to the move you get on a low one. That's how I feel about it.
Sure. Okay. All right. Well, tomorrow's going to be a big day, and so is Purdue. Remember, we get a 1-2 punch with the CPI and PPI.
Yeah, that's right. But look, I think one of the big talking points has been the new all-time highs in the S&P and the S&P futures, new closing highs in the Dow. We've got JP Morgan kicking us out tomorrow on a more formal basis with the banks reporting, some of the big, sexy, innovative, big tech names that everyone loves to trade and loves to be sort of get that one day, vol shock from earnings. They come out later this month, and Nvidia not until November. But I think the bar for me in earnings is actually a little bit lower than previous quarters. Given the macro environment that people have been focused on, it feels like the market wants to move higher. The equity market, we're starting to find a bit of leadership from Apple again. Nvidia was looking really strong. It's had a bit of a breather in the session there, but we're starting to find buyers, and that's been broken out and creating a higher high. So if that can find the momentum going forward, then fundamentals don't necessarily matter. It's about the flow that drives it up there through optionality and various factors. So if we could get big momentum going into there, but it feels to me that the bar, I know we're going to get 80% of companies beating expectations on EPS, 68 on sales. That's always happens. But in terms of the how stocks react on the day, I think the bar is a little bit lower, and therefore I feel like there's probably upside risk to this from a bottom-up perspective here, Blake.
No, I would think so too. And it's real simple. Just look technically. This week we held where we needed to hold in the S&P, and as long as we don't take out new lows for the week, then the path of least resistance is higher. And it's also a wall of worry, Chris, between the ongoing conflict in Iran and Israel, the ports being shut down, Milton terrorizing Florida and parts of the United States, and the election upcoming. And what would a Harris or a Trump presidency look like? Look, markets don't care. They're going higher, and like I said, as long as we hold this week's low to the point or the pip, as long as we hold that, path of least resistance is higher. And it's crazy how big this market is, Chris.
But I was going to say, I was just going to say,
it's a fool's errand to try to fade this market at this point.
Yeah,
go ahead.
The pullbacks have been so shallow. They've held the recent lows S&P futures, and they've used it as a platform. They push through the top end of the range. Obviously, a lot of ranges, range breaks do fail, so we need to be cognizant of that. But I just like the way that the pullback's been shallow. It's held the lows, bang, breakout. Got to like that. But I wonder as well, how much international capital went into the Chinese and Hong Kong equity markets, because we got this massive stimulus, fiscal, was talked up, but we got, obviously a big incentive for brokers to come and put capital to work, buy back stocks in the corporate landscape. And, how much money went into that, thinking that we were, we're going to get a sustained rally. Obviously, we saw a very strong rally, but that's obviously deflated now. I wonder how much money, international money, went over there, because everyone was so underweight China, and maybe some of that capital has come back to America because, we've still got that economic resilience story there. So maybe that some of those flows have sort of been recentered there.
Perhaps, and that's probably one thing that we're going to look at in the charts ahead in just a little bit. We're going to talk about China, and I do think there's going to be I think the 2025 story, Chris, is really going to be a divergence between U.S. equities and other markets, whether it's Germany, whether it's China, or different parts of Asia. But that's a 2025 story. But you know what's a 2024 story is the U.S. election that's up and coming here in the next couple of weeks. So I thought we would talk about, a second term President Trump. I know I might have just irritated a few of you guys, but look, it seems like that's the way we're leaning right now, but polls will change. We got Harris, we got Trump, and it is a neck and neck, depending on what polls you're looking at, it's really damn close. And I know it's a little early, but it's probably a topic that we'll be at least referencing every week for the next several weeks coming up to the election that is on November 5th. Chris, I have to say, I know there's a lot of moving parts. Trump president, I'm just going to throw this out there because I want us to talk about it. Trump presidency, you buy stocks for at least a spike higher. You buy the dollar. The higher dollar, higher equity markets, tariffs. The economic play. Harris, you sell equities, you sell dollar. I know there's more to it than that, but right on the surface, that's like the initial, my gut feelings coming into this election. Let's get your thoughts real quick.
Yeah, I think, he's certainly in the betting markets, Polymarket and Betfair, for example, he's ahead at the moment. But you go into where he is at the moment on Real Clear average polls. He's ahead now in the swing states in Pennsylvania, Michigan, Georgia, Arizona as well, and that obviously that's where people are pricing risk from. But I think if you take the Harris situation, if she was to get in power, a lot of the big market moving policies that she has, raising the corporate tax rate, raising personal taxes on people earning over $1 million, they're not going to get through. It's just not going to happen because the Democrats are not going to win the Senate. So, a lot of the big market moving issues that she's got, aren't going to see the light of day. So it's really a continuation of what we've got at the moment, which isn't terrible in terms of market policy. She's still pushing the deficit out. But I think in terms of Trump, if that was to happen, the first port of call is what does the Senate look like? If there is a divided Senate, then I think you just go. The focus just goes straight onto trade tariffs because you can push them through without the blessing of Congress. And yeah, I agree. That's a dollar positive. We're seeing that now in dollar mex vols, in euro dollar vols, and it just adds to my situation that the euro dollar's got downside. Dollar CNH has got upside, dollar MEX has got upside in that because tariffs have come through. But the question we've got to ask in that, Blake, is when tariffs go through, and we've got to believe that they will do, he's put his campaign on it, whether they go through it to the extent that he's talked about is no fact, is how long is it going to take to implement? It should be pretty quick. Secondly, what will be the counter response from these countries that are going to have tariffs? And that could be where increased volatility is. But yeah, I like the dollar on that. Tariffs will raise the price level. We could have an influence in Fed thinking. But if it was to get a red wave, and as his odds increase, so does his odds of getting the House, then we start thinking about the idea that he's going to be able to pass, deregulation, like he could pass tax cuts. That is where the big kicker for equity comes in, and that would be where I'd be buying US equities over global equities with my ears pinned back, and that's where the US outperforms. So tariffs come through with him coming through, but the broader move comes if he can get the House and the Senate as well, and that's when you can start passing a lot of the big issues there. So I think it's going to be anything to play for, but yeah, watching those polls, watching the betting markets, and we'll be able to price risk. I think, yeah, as I say, the big issue with Harris is that a lot of her policies are based on sort of social issues, abortion and women's rights and other factors. They're not necessarily market issues. The big ones that she wants, corporate tax rate hikes, she won't be able to pass them without both chambers of Congress. So it's a bit of a non-deal, don't you think?
It's going to be spicy, Chris. It is going to be spicy. So, keep your.
The other thing, Blake, is that we might not get a result on the day. It might take 5 or 6 days or so to come through, like we saw in 2020. So it's not an easy thing to understand when we get those moves.
And this is something that I was talking with traders from the Forex analytics community earlier today about that. And there's something that you need to think about this. Let's say, and I know the producer is going to kill us, so let's just make it real quick. If there is a Harris win, not only will stock markets go down and the dollar will probably go down, but the social unrest will probably be at a fever pitch, and the not knowing if she won or not is going to create chaos. And so the sell-off that you think would come in equities on a Harris win might actually get some legs due to what you just pointed out, which is something that I think is, something that hasn't been talked about too much.
Well, maybe cast your vote November the 5th and get yourself over to Australia, mate. Get out of Dodge. Anyway, let's go to the charts that matter. Right, let's talk setups. Let's talk euro dollar because we just talked at length about what's been going. Let's see it pictorially. But yeah, we talked about this one last week. We sort of said, I suggested there's some bit of downside risks. It's been a bit of a slow burn. It's been a bit of a grind. I would like that range to have picked up. I'd like that volatility to pick up. But, it's breaking levels. You can see the horizontal support level. We've broken through that. We've broken out of the double top. So effectively, from that double top pattern, you've got some decent downside. It's finding sellers and rallies. So it just, again, perpetuates my view that, or accelerates my view that the path of least resistance is down. That said, obviously we've got the CPI number tonight, and while the Fed do look at the labour market more intently, if we were to see a big miss to consensus, then that could have implications for the dollar. But yeah, everything fundamentally is working for this to go lower. French budget, Italian budget, Spanish budget, savings rate. The election risk if Trump comes in, if China was to really go down and slow down because the market is not sensing fiscals working, you're going to suffer. If geopolitics does continue to evolve, and we were seeing Iranian oil production being impacted and the Brent price were to reverse back up and trade higher, Europe's going to be much more negatively affected by a higher Brent price. So for me, a lot of these factors lead me to believe that we're going to see a lower euro dollar. The technical support this one at the moment does feel very heavy, and rallies are probably likely to be sold here.
And a double top range extension takes us simply to 108. So if you guys are targeting the euro downside, 108 seems like a very natural target if this trend continues. So thanks for bringing that up, Chris. My first setup is going to be the China 50. You asked the question last week, Chris, and we both agreed. Yet last week was not the time to be chasing the Chinese markets higher. But now we've seen a couple of day pullback, big percentage-wise pullback. We're coming to the 618 retracement. We're coming down to a breakout point. I'm kind of thinking, if you want to be a buyer, and I know you have a lot of Chinese traders that watch this show. I think these are the levels that you need to start looking for, to be interested in. I think while we're above 13,000 in the China 50, and I know a lot of your traders trade your ETFs that happens to be this chart that I referenced. I think this is the level to start looking. I think you have a great risk reward, and manageable risk is what us as traders look for. So I would see how we respond around that 13,000 level. And if it seems like it's finding some support here, I think that's the level that you start buying China. And maybe, Chris, you buy China, sell S&P. Since you brought it up, maybe that's the trade.
Well, the thing is, if you're going to start dabbling in those waters, you need to be aware that the volatility in obviously Chinese equities is significantly higher. And so when you're talking about position sizing for you need to adjust for the relative volatility. Otherwise, one goes up 5% and the other one goes up 1%. So you need to, volatility adjust those positions. But I think also the other thing, Blake, is that, on Saturday at 10 a.m. local time, Beijing time, we're going to get the Ministry of Finance coming out of a press conference. There was some disappointment, obviously, we've seen the price that the NDRC didn't display enough on the fiscal side earlier this week, and that's why, we saw it deflating. But Saturday we do get the Ministry of Finance coming out talking about its fiscal plans, and while the NDRC don't actually look after fiscal, the Ministry of Finance do. So there could be some significant gapping risk, and if the market likes what they hear after coming back a little bit, we could see these markets run hot next week, and we may see some short covering going into that, which supports your trade there. So definitely a big one. If anyone's dabbling in the Hang Seng, the H shares, if the CN50, dollar CNH, or the China proxies, be aware that we do have some fairly significant weekend risk. Anyway, let's go into gold. Let's bring that one up because it's one that we're bringing up. Obviously seeing some big flow at that at the moment. Obviously we've been treated to this series of higher highs, and we do see the market rallying and then forming a consolidation. It breaks out. It's been very constructive price action in the way that it works. You really always want to see that. Markets make a new high, consolidates, buyers push it through, we cause a stage, and we've been seeing that really for most of the year, and that's been very, very constructive. But now what we're seeing is the re-emergence of the US dollar. Now the gold price has absorbed a lot of the dollar buying recently, and partly that's down to perhaps people looking to buy gold as a political hedge, as they've been doing with things like the Swiss franc as well. But with the market not seeing any new news in the geopolitical front, and looking at higher yields both on a nominal and real basis, and also a stronger dollar, and actually some strong attractions about the US dollar. The gold price has now started technically to break down. We've broken out of the recent range lows. We're eyeing ourselves in obviously the round number 2600, but more importantly is that last consolidation high of 2585. I think we go down there. It feels like it's cracking. The market's long of gold at the moment. Some of that positioning needs to come out, and if my view that the dollar's got upside risks manifest, then I think we hit 2585. But right now, if I'm looking at the technicals on gold and saying to myself, well, what do I do? I wouldn't necessarily be buying right now, so I'll be standing aside and waiting for price to reveal itself. So that's again those order book dynamics are going to keep a few buys out and then sort of push it down to that 25.85, which I think is where the risk is.
It's hard to be a dollar bull and a gold bull at the same time, Chris. So great look there. All right, so the chart the last setup I want to bring to your attention is the S&P 500. What you're going to notice is we're coming up. This is a big confluence on my week ahead video. I talked about it. Really kind of focused on this chart because we're coming up to a confluence of not only the 127% extension of that last big move lower that you saw, the summer when everybody thought there was a major correction coming, but also the smaller move, that middle move that happened in September. We're at 161% extension of that move. That all comes in just above 5,800. It comes in around 5,830 to 5,840. It is, I think, going to be a really big level because relative strength is divergent. So I think it's going to be kind of do or die for the S&P. I think it's going to be one of those levels that sets up for a setup, because if we do break higher and let's say risk continues higher and we start making it towards 6,000, that relative strength that's divergent, you're going to see it break through to the upside. You're actually going to see it poke through that descending trend line that you have on the bottom pane of this chart. You're going to see it start to poke up, and it's going to take us to 6,000 in the S&P. The flip side is if we hit this confluence of fib levels, we might come right back down to the 5680, which is the big level that we held all week and we held last week as well.
Yeah, do or die. I mean, I'd look at the S&P right now. We talked about it at length, but to cause a 10% drawdown right now, I couldn't tell you what that situation is going to be. Okay, geopolitics aside, but I'm not going to sort of price that right now. But yeah, I couldn't tell you what. Yeah, it's going to have to come from the economic side, and right now the economics, it's going to take time for that. If it was to deteriorate, it's not going to happen overnight. So, I think economics is ultimately the thing that drives a significant downturn in the S&P, and right now the US economy is in a good spot. The Fed puts in place. It feels to me that there's a pretty low risk of a decent drop. That's probably when it happens but yeah, right now I couldn't tell you what it's going to be.
And and that's the again, as a trader, you know exactly where you're wrong. 5680 was the low from this week. It was the low from last week, and as long as that holds, well,
market will do what it wants to do, buddy. Anyway, let's go to play of the day. Right, well, I'm going to look at the Germany 40 after being super bullish on what's been happening in the US, and I could easily say stay long S&P, stay long Nasdaq, buy into Nvidia. Yeah, there's a few individual names I like. ServiceNow on the equity side I like. I think there's quite a lot on the hardware side that I'm looking quite favourably at. Aussie Kiwi was a trade I looked at last week and talked about. It wasn't my formal idea, but I think that's been getting huge attention after the Kiwi central bank cut by 50, and I still think there's further juice to get through 111 on that. Kiwi's probably the whipping boy now, but right now for me it's this idea about being long Germany 40. Now you've got the German economy in recession, but yeah, the equity market's breaking to new highs. It doesn't matter. There's so many companies in Germany that are not a reflection of the economy. It doesn't matter at all. This is about rate cuts. It's about liquidity. It's about flow. It's about sentiment. And right now, what I like about this is we've held very nicely that horizontal support. Yeah, we saw the wicks trade through there. We then see a second higher low coming through, and we've broken out with gusto. So I like this. I like what I'm seeing in the price action. I'm sensing the bids come in, stronger bids. And the market's closed near the highs of the day, so the bulls are firmly in control. Obviously, we don't know the future; no one does. But when I look at this setup right now, if we get a break through the highs on the session ahead, I think there's going to be a nice rally in the pub, and I'm long. So I think I just love what I'm seeing on this chart.
Just like U.S. equities, there's nothing not to like. It's holding all the right levels, right? And I think can't get much better than that. All right, Chris. Well, my play of the day is going to be the U.S. dollar, Japanese yen, and this is where you have to become your own currency ronin. Do you know what the definition of a ronin is? It's a samurai without a master, and I do not have a master in the currency market. We master the currency market, right, Chris? So we are going to be currency ronins here.
And this
is where I'm going to actually take a little bit of a stand, as I'm actually looking to buy yen. I've been talking about this trade the last couple of weeks. I've not been yen yen bull, because back when we were down at 140, but now that we're getting close to 150, these are the levels that I am attracted to. You'll notice we hit the 161% extension of the new prime minister when the market was pricing in Takashi, and then we got into Shiba. We just hit the 161% extension of that election night move. We are also nearing the 200-day and the underside of a broken channel. So while we're below the 200 VMA, which comes in right around 151, I want to be on the short side. So anywhere here between 149.50 to 151, I'm looking to be short the dollar yen. And matter of fact, I've already started tipping my toe in, because I am a currency ronin, buddy.
I like that. I've never heard that. I know I've seen it in the film, but yeah, good one. I feel that the risk is probably a bit of a squeeze higher. I'd be looking to fade into about 152. I think that's where you got top of the iCloud. I think there's probably a level to look at, but I don't have a position, so I can't really talk this one through. But that's where the risks are. Anyway, Blake, great thoughts there. Obviously, a lot to play for in terms of election risk that's brewing, CPI ahead, US earnings, markets all-time highs in the equity stuff, some good momentum as well brewing in the DAX and also in the Nikkei as well. One to put on the radar. Obviously, we've soon talked about what's happening in China. Some whippy rides, and if you're swimming in those circles, obviously position sizing is what's going to keep you in the game. Keep it small at the moment until things settle down. Anyway, thank you everyone for watching. Smash the like button, hit the subscribe, and we'll see you back next week for more of the trade-off.